Hey, Archie, a lot of people want to know what the differences are between traditional mutual fund and an exchange traded fund.
Rob, that's a great question. They may seem similar, but there are some really key differences. So let's dive in. Weekly wisdom to help you retire and stay that way. This is Last Paycheck. Welcome back to the Last Paycheck Podcast, brought to you by Hoxton Planning and Management. We're your hosts, CFP professionals Archie Hoxton and Rob Hoxton. And we've got an interesting topic for you today. Today, we're going to be talking about two really popular and important investment vehicles, probably the most popular. If you've invested at any point in your life, you've probably owned at least one or maybe both of these. And I think we'll kind of just talk you through what they are, what the key differences between them, and why you might own one over the other. And these vehicles are mutual funds and exchange traded funds, or also known as ETFs. You'll most commonly hear them called. So they're some of the most important investment vehicles out there. They're hugely popular. And so we're going to try to demystify them a little bit.
So mutual funds, Archie, mutual funds have been around since like the late 1920s, maybe?
I think so, yeah. I mean, they started being regulated in around the time of the Great Depression.
Yep.
1940 is the 1940 Act. You sometimes hear a 40 Act fund. They've been around a while. ETFs are kind of the younger cousin, you might call them, or the younger brother or sister. They're much more recent, and they seem like they're simpler, but interestingly enough, they're actually a little bit more complex. And we'll kind of get into that at a high level.
I love the things that they have in common. The traditional mutual fund originally was an actively managed fund. So it would have been a pool of investments where lots of different investors could contribute a little bit of money to that fund, that mutual fund, and then the fund manager would go out and pick stocks or bonds according to whatever they've published as their investment objectives. So if their investment objective is to buy and manage a portfolio of blue chip US large cap stocks, then ideally they would limit themselves to just buying and owning those types of funds. But the beauty of it is a small investor could make an investment in that fund and be immediately diversified across dozens or even hundreds of underlying investments.
Right. Yeah. I mean, the thing about mutual funds is they were the way that the ordinary investor with limited capital could get their hands on lots of different stocks and potentially, put their money with someone with an investment strategy that they really like, maybe had a good track record. And instead of needing to have, several $100,000 to put in to get the proper weighting between all of these different companies that this professional manager wanted to buy.
Yeah, to get that diversification.
Yeah. And sometimes with an active, maybe they've got a heavier position here and a lighter position here, but maybe you've only got $1,000 or a few $1,000s. You wouldn't be able to get that kind of exposure with that much money unless you're pooling with lots of other investors. And that's what allows this diversification, or in an active manager's case, sort of a specialized, investment strategy that they've created. It's hard to do as sort of an ordinary investor.
Right. Made it accessible to, just like you said, ordinary investors. And it's a part of the investment world that grew very quickly.
Yeah.
And there were different ways, typically they were bought from a broker or some sort of an investment advisor. And they typically had commissions. And back in the day, that when they first started, the commissions were just insanely high.
Right.
I remember when I was studying for my securities license, I think that the commissions were limited to like 8.5%. Which, if you think about it, on a $100,000 investment, that would have been $8,500 in commissions. And it's every time you buy it.
Right.
Right. So if you buy it and then you're your advisor suggested that you sell it and buy something else, well, then you had another commission. And it was usually, in the early days, an upfront commission with internal ongoing costs. Well, and then they came up with a different type of commission, which was one that you didn't really see. You were still paying it, but you didn't really see it. It had a contingent deferred sales charge, in which if you held it long enough, the surrender charge would go away, and it would seem like you never paid a commission, but you actually were paying a commission, and the broker was most certainly being paid a commission. And then after that, then you started to see the proliferation of and popularity of no-load mutual funds.
Right. Yeah, and those are primarily what you see today. And you had sort of the introduction of the index fund that people really love today. They're super, super low cost. They're limited management. It's just when you put your money into the fund, the manager buys across an index, all of the companies in the S&P 500 weighted like the S&P 500 to match the returns of the S&P 500 or any other index. Mm-hmm. That sort of introduced the idea, well, we could probably do this for really cheap. And it caused a fee compression in the mutual fund world. Everything, you saw expense ratios falling. And, sometimes now extremely low expense ratios. With the index fund, I think this is part of what inspired the birth of ETFs, because ETFs for a long time were mostly like index funds. They operated in a similar way to an index fund. You were buying it, and you were buying kind of a set basket of investments that matched an index.
Yeah,
but the way they work is quite different.
When people think of an index, the ones that come to mind are like the Dow Jones Industrial Average, mm-hmm. Which is 30 stocks, or the S&P 500 typically is a very popular one. But there are just hundreds of different indices that these exchange traded funds and index mutual funds can mirror. And right. Like you've got the Russell series of indices, like the Russell 1000, which is 1,000 sort of core U.S. large cap stocks. And then you got the Russell 1000 growth and the Russell 1000 value, or the Russell 2000, which is the smaller public companies. Right. And then you have a whole host of indices on the fixed income side or the bond side as well, like the Barclays Aggregate Bond Index. And you can find an ETF or two or three ETFs that will mirror any of those indices.
Yeah. And now you can kind of, the playing field is slowly becoming more equal between, the and we'll talk about some advantages and disadvantages of both. But the playing field is sort of starting to become more equal, because now you can get an index fund in the exchange traded fund wrapper with the benefits that come with that. So
yeah,
the quick version, a mutual fund, you put money in, the manager buys the investments. If you want to take money out, the manager sells investments and gives you cash. Works fine, but it's not very efficient from a tax perspective, because if they have to realize capital gains when they sell the investments to get investors out of it, everybody in the fund shares those capital gains.
Can I tell a story?
Oh, yeah.
Yeah, so this is really shocking to a lot of investors, but way back in 2008 and 9, during the credit crisis, people were buying shares of mutual funds. In early 2008, for instance, they watched the value of that investment drop by 40, 50, 60%, depending upon what they were investing in. So they held those investments, but they watched the value of their investment drop substantially. Right. But at the end of the year, they had to pay taxes on capital gains that were realized. Archie, touch on that. How can that happen? This was something that people were losing their minds over, because they didn't understand how these instruments worked.
So a mutual fund, you think about, there's a basket of investments. You put money in with all the other people. Investments are purchased with that money. And then so you can value the fund based on how much all the investments within it are worth. If the investments are declining in value, if no one gets out of the fund, it would just bounce back, no capital gain problem. But in reality, that's not usually what happens. When a pooled investment vehicle is declining in value, people are panicking and selling it and getting out of it. That's forcing the manager to sell investments in the fund to get people out of it. And that's creating capital gains because they eventually have to start eating into the positions that have grown to redeem investors out of it. So you can have a fund that's declining in value because the stock market's falling, but they're selling because somebody else wants out of the fund, and you have to pay your share of that capital gain.
Because leading up to that, the shares had grown in value, right?
Right.
Yeah, so there was a gain within the portfolio, but an unrealized loss for the people who were still owning it.
Yeah.
And those realized gains got passed through to those shareholders, right?
Exactly. This is exactly the key benefit of exchange traded funds. There are many benefits. The primary benefit is that they don't work the same way in how you buy it and sell it. Instead of going to the manager and saying, here's $10,000, I want a part of the fund. You give $10,000, they give you shares in the fund. And then if you want out, they sell investments in the fund and give you the cash. Exchange traded funds don't work like that. You're actually buying the fund on an exchange, hence the name exchange traded, like you would a stock. So some other investor wants to sell this exchange traded fund, you can buy it from them. The investments in the fund aren't actually changing hands, just the share. Now, the manager, instead of taking investors' cash and buying investments in the fund, what they're doing is they're taking the shares of the exchange traded fund, giving it to a big institution and saying, I'll give you all the shares of this fund if you give me the securities that will make up the fund in exchange. I want all the S&P 500 stocks. And then you can go and sell the exchange traded shares on the open market. So when you have a relationship like that, it's called in-kind trading. There's no capital gain realization for this kind of swap. So it makes the fund super, super tax efficient because they're not constantly buying and selling securities when people want in and out of the fund.
This is super important if you're talking about a taxable account. If we're talking about your IRA, it doesn't really make a difference, right? Because all of those, whether it be a Roth or a traditional IRA or rollover IRA, those monies are all just, you're not recognizing taxes every year, regardless of what happens within the underlying investments. So This is one of the things I love. And it's funny because, our clients will ask us, well, why are we using mutual funds or why are we using ETFs? And for us, we often will use a combination of the two, even in a taxable account.
Right.
Simply because in our view, we like to use exchange traded funds in very low cost and very tax efficient exchange traded funds in the most efficient asset classes, like say large cap growth. Whereas in the less efficient asset classes like small cap US stocks or emerging market stocks, if we use an actively managed mutual fund, or if there is an actively managed ETF, we might get a little performance benefit there. So it's a trade-off.
Yeah, they're both valid and relevant tools. It just depends on, your circumstances, the type of account. You want to take all these things into consideration. If you like active management, you can have more options in the mutual fund world because it's just been around longer. There are more active ETFs now. They're coming out all the time. But, if you're looking at comparing two index funds, a mutual fund versus ETF, odds are the ETF is probably going to be less expensive.
And more tax efficient.
And more tax efficient. So it's like, you might want to go with that.
Yep.
But it's just going to depend on every circumstance. and your unique needs as an investor. So there's all kinds of interesting differences. Another, that's really important is that mutual funds only get priced one time per day. They get priced at 4:00 when the market closes. They say, here's what all the investments are worth as of 4:00 today. This is the share price of the mutual fund. Exchange traded funds, it's all throughout the day, just like stocks. So, that's another key consideration there. It's easier to cancel a trade in a mutual fund. If you make a mistake, if you're prone to mistakes, they're much more forgiving. But hopefully that's not an issue. There are all kinds of interesting little tidbits. We could probably do another episode on this, but I think that's about all the time we've got. So, yeah. Well, if you like the episode, remember to subscribe to the channel. We have lots of people that listen that aren't subscribed. We'd love to be able to stay on your feed. Leave us a comment if you have questions or ideas for episodes. Like the video, share it with your family and friends, and we'll look forward to seeing you next time. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.